Ever pondered on the difference between cyclical and non-cyclical stocks? Stocks or shares are slices of ownership in a company. They represent a claim on part of a company's assets and earnings. In the financial markets, they play a crucial role, serving as a key avenue for companies to raise capital for expansion and innovation. But not all stocks are created equal. Some are more susceptible to economic fluctuations than others. Today, we will shed light on cyclical and non-cyclical stocks, their differences, and how they impact your investments. Imagine you're the owner of a luxury car manufacturer like Ferrari. Now let's use this scenario to delve into the world of cyclical stocks. You see, cyclical stocks are just like your imaginary Ferrari company. They're tied to industries that flourish when the economy is strong, but may struggle when things aren't so rosy. Why? It boils down to consumer demand. When people feel confident about their financial situation, they're more likely to splurge on a shiny new Ferrari. However, when the economy hits a bump in the road, luxury purchases often take a back seat. That's when cyclical stocks, like our Ferrari example, can experience a dip. It's not that the company is necessarily doing anything wrong. It's simply that fewer people are in the market for a high-end sports car during an economic downturn. So, cyclical stocks are a bit of a roller coaster ride, mirroring the ups and downs of the economy. They can provide significant returns during boom times, but they also carry a risk. When the economy slows, these stocks can underperform. This is why savvy investors keep an eye on economic indicators. They're looking for signs of economic growth, which could signal a good time to invest in cyclical stocks. On the flip side, they're also watching for signs of an economic slowdown, which could mean it's time to steer clear of these stocks. So, cyclical stocks like Ferrari are highly dependent on the economic cycle. It's all about timing, understanding the market, and knowing when to hit the gas or pump the brakes. Now, consider this. You're the owner of a supermarket chain like Walmart. A fascinating thought, isn't it? This scenario provides a perfect introduction to non-cyclical stocks. Non-cyclical stocks, also known as defensive stocks, represent companies that provide essential goods and services, things that people need regardless of how well the economy is doing. Think about it. Whether the economy is booming or going through a rough patch, people still need to buy groceries, right? That's where your imaginary supermarket chain comes in. Just like Walmart, your supermarket chain would be a non-cyclical stock. This is because supermarkets offer products that are always in demand, like food and other household necessities. Even in times of economic downturn, when people might cut back on luxury items or discretionary spending, they still need to eat and maintain their households. This makes non-cyclical stocks relatively immune to the ebbs and flows of the economy. They can provide steady returns because their business isn't as affected by economic changes. Of course, no investment is risk-free, but non-cyclical stocks are generally considered to be less volatile and more resistant to economic downturns. So, the next time you're considering where to invest your money, think about your imaginary supermarket chain. Remember that non-cyclical companies like this can offer a degree of stability in an unpredictable market. Thus, non-cyclical stocks, such as Walmart, tend to be more resistant to economic fluctuations. Cyclical or non-cyclical stocks, where should you invest? Let's take a moment to recap. Cyclical stocks are like the pulse of the economy, beating in time with the highs and lows of the business cycle. When the economy is on an upswing, cyclical stocks such as those in the automotive, travel, and luxury goods sectors can offer significant returns. But remember, when the economy takes a downturn, these stocks can also see substantial losses. On the other hand, non-cyclical stocks, sometimes also referred to as defensive stocks, are the steady rhythm that plays in the background. These are the stocks of companies that produce goods and services we need on a daily basis, like utilities, healthcare, and consumer staples. They tend to hold their value even when the economy stumbles, offering a degree of protection against market volatility. So where should you put your money? Well, that's a decision only you can make. It depends on your individual investment goals, your appetite for risk, and your reading of the economic climate. If you're a risk taker hoping to make a quick gain during an economic boom, cyclical stocks might be your game. But if you're looking for long-term stability and steady growth, non-cyclical stocks may be more your speed. Remember, whether cyclical or non-cyclical, the key to successful investing lies in knowledge, patience, and diversification. All right, that's it for our comprehensive guide on cyclical and non-cyclical stocks. We hope you found this video informative and that it's given you some valuable insights to help you make more informed investment decisions. If you found this video helpful, don't forget to hit the like button. It really helps us out and lets us know that you're finding value in our content. Also, if you're not already a subscriber, why not consider hitting that subscribe button too? We produce content like this on a regular basis, diving deep into the world of investing to help you understand and navigate the market. Remember, your likes and subscriptions help us create more content like this. Thank you for watching, and until next time, happy investing.